For decades, the Japanese yen carry trade has been one of the most reliable and seemingly straightforward ways for large financial institutions to generate consistent profits. The basic premise is incredibly simple, almost like a financial free lunch. It involves borrowing money in a country with extremely low, near-zero interest rates, Japan, and then converting that money into a currency of a country with much higher interest rates, such as the United States. The borrowed funds are then invested in assets denominated in that higher-yielding currency, like government bonds. The profit comes from the carry, which is the difference between the high interest earned on the investment and the negligible interest paid on the loan. It's a strategy that has printed money for hedge funds, banks, and savvy investors for years. This trade has become a cornerstone of global finance, not just a niche strategy for a few specialist funds. The Bank of Japan's long-standing policy of keeping its lending rates pinned to the floor has created a gigantic, multi-trillion-dollar pool of cheap capital. This has made the yen the world's primary funding currency. When the difference, or spread, between United States and Japanese interest rates is wide and stable, the profits can be immense and predictable. For example, borrowing yen at 0.1% and investing in United States treasuries yielding 5% creates a juicy 4.9% spread. When you apply that percentage to billions or even trillions of dollars in borrowed funds, the profits become astronomical, funding everything from banker bonuses to further speculative ventures. The success of this trade hinges on one crucial assumption: stability. It requires that the core conditions that make the trade profitable, low Japanese rates, high foreign rates, and a stable or weakening yen, remain in place. For a very long time, this has been a safe bet. The Japanese economy has struggled with deflation and slow growth, forcing its central bank to maintain an ultra-accommodative monetary policy. Meanwhile, other major economies, particularly the United States, have experienced periods of growth and inflation that necessitated higher rates. This created a perfect, seemingly perpetual engine for profit. The sheer scale of this trade has grown so large that it now underpins the liquidity of many other global markets, a fact that is often overlooked in times of calm. However, this apparent simplicity masks a deep and dangerous fragility. The carry trade is fundamentally a leveraged bet on financial stability. The enormous sums of money involved mean that even small, unexpected shifts in currency values or interest rates can transform those steady profits into catastrophic losses with shocking speed. The very mechanisms that make the trade so profitable in good times are the same ones that can cause a devastating and rapid unwind when conditions change. What appears to be a simple arbitrage is, in reality, a slumbering giant. When it awakens, the consequences can ripple through the entire global financial system, catching complacent investors completely off guard and turning a surefire bet into a source of systemic ruin. The first and most direct threat to the tranquil profitability of the yen carry trade is a change of heart from the Bank of Japan. For years, the foundation of this entire enterprise has been the near-zero cost of borrowing yen. If the Bank of Japan decides to raise its benchmark interest rate, even by a small amount, it directly attacks the profit margin of the trade. The cost of funding suddenly increases, squeezing the spread that traders rely on. A minor adjustment by a central bank can translate into billions of dollars in new expenses for institutions that have borrowed trillions of yen. This is the first crack in the carry trade's armor, and it can appear with very little warning. Let's consider a tangible example to illustrate the scale of this risk. Imagine a large hedge fund has executed a massive carry trade, borrowing 10 trillion yen. At a borrowing cost of just 0.1%, its annual interest expense is a manageable 10 billion yen. Now, suppose the Bank of Japan, concerned about rising inflation or a weakening currency, decides to normalize its policy and hikes its rate to 1%. This may seem like a modest increase in absolute terms, but for a hedge fund, it's a seismic event. The annual borrowing cost for its 10 trillion yen loan skyrockets from 10 billion yen to 100 billion yen. This is an instantaneous increase of 90 billion yen in expenses, which could single-handedly erase a significant portion of the expected profits. The problem is not just the direct increase in cost, but also the signal it sends to the market. A Bank of Japan rate hike is a statement of intent, suggesting that the era of ultra-cheap money may be coming to an end. This can trigger a frantic rush for the exits as carry traders, all operating on the same assumptions, simultaneously realize their profit model is broken. They must start unwinding their positions to avoid further losses from potentially higher future rates. This collective action creates a feedback loop. The scramble to close trades puts upward pressure on the yen, further compounding losses and intensifying the panic. What begins as a minor policy tweak can quickly escalate into a full-blown market dislocation. Furthermore, the risk is not just that rates will rise, but that the market will begin to anticipate that they will rise. Even rumors or hawkish statements from Bank of Japan officials can cause the cost of borrowing yen to creep up as lenders start pricing in future hikes. This forces traders to make a difficult choice. Do they hold on and hope the central bank bluffs, or do they unwind their positions early and forfeit future gains? This uncertainty itself can destabilize the trade. The moment the market loses faith in the Bank of Japan's commitment to zero rates, the carry trade's foundation begins to crumble, threatening not only the traders involved, but the broader financial system that has come to depend on their river of cheap liquidity. While a rate hike in Japan directly increases the costs of the carry trade, an equally potent threat can emerge from the other side of the equation, a decline in the returns on foreign assets. The entire point of borrowing cheap yen is to invest it in something that yields a significantly higher return, like United States Treasury bonds. If the United States Federal Reserve begins to cut its interest rates, the yield on these bonds falls, narrowing the profitable spread from the income side. This can be just as damaging as a rise in borrowing costs, as it directly shrinks the revenue that makes the trade worthwhile in the first place. A dovish shift from the Fed can quickly turn a gusher of profits into a mere trickle. To quantify this, let's revisit our investor with the 10 trillion yen loan. At an exchange rate of, say, 150 yen per United States dollar, this loan converts to approximately $66.7 billion. If this sum is invested in United States assets, yielding a healthy 5%, it generates an annual income of about $3.33 billion. After accounting for the 10 billion yen, or roughly $67 million, borrowing cost, the profit is substantial. However, if the United States economy weakens and the Federal Reserve is forced to cut its policy rate, causing the yield on those assets to fall to just 3%, the annual income plummets to roughly $2 billion. This represents a loss of over $1.3 billion in expected earnings, drastically altering the risk-reward calculation of the entire position. This scenario is far from hypothetical. Central bank policies are cyclical, and periods of rate hikes are inevitably followed by periods of rate cuts in response to changing economic conditions. Investors in the yen carry trade are therefore making a dual bet, not only that the Bank of Japan will remain dovish, but also that the Federal Reserve, or another target central bank, will remain hawkish, or at least stable. This double contingency makes the trade inherently more fragile than it appears. The global economic landscape is interconnected, and a slowdown in one major region can easily prompt a policy response in another, leaving carry traders caught in the middle of shifting monetary tides. The danger is magnified because all participants are watching the same indicators. The first hint of a United States economic slowdown or a softening tone from the Fed can trigger a wave of preemptive unwinding. Traders know that if they wait until the rate cuts actually happen, the value of their United States bond holdings may have already fallen and the rush to sell will be crowded. This creates a powerful incentive to act first leading to sudden and sharp sell-offs in United States assets and a corresponding surge in demand for yen. In this way, a potential change in United States monetary policy can unleash the same destructive unwind dynamics as a change in Japanese policy, demonstrating that the carry trade is vulnerable from both ends. Of all the risks facing the yen carry trade, none is more feared or more destructive than a sudden and sharp appreciation of the Japanese yen itself. While changes in interest rates erode profits over time, a violent move in the exchange rate can wipe out an entire position's principal in a matter of hours or days. The core of the trade involves being short the yen, that is, borrowing it with the obligation to pay it back later. If the value of the yen rises significantly against the currency it was converted into, like the United States dollar, it takes far more of those foreign currency assets to buy back the original amount of yen needed to repay the loan. This can lead to staggering capital losses that dwarf any gains made from the interest rate differential. Let's return to our 10 trillion yen loan. Suppose the trade was initiated when the exchange rate was 150 yen per United States dollar, converting the loan into $66.7 billion. The investor happily collects interest on these dollar assets. But then a financial shock occurs, perhaps a global crisis that sends investors fleeing to the traditional safe haven of the yen, and the exchange rate strengthens dramatically to 120 yen per dollar. To repay the 10 trillion yen loan, the investor now needs to acquire that much yen on the open market. But at the new, stronger rate, their $66.7 billion portfolio is only worth 8 trillion yen. This leaves them with a staggering 2 trillion yen shortfall, equivalent to roughly $16.7 billion. This single loss would obliterate years of accumulated interest rate profits. This currency risk is the Achilles heel of the carry trade, because the yen has a well-established history of behaving this way. During times of global market stress, such as the 2008 financial crisis, the yen often strengthens rapidly as Japanese investors sell their foreign assets and repatriate their capital. This creates a vicious cycle for carry traders. The very market turmoil that might cause their foreign assets to fall in value also causes their yen liability to soar. They are hit from both sides. This is why a yen carry trade unwind is often synonymous with a global risk-off event, where the unwinding itself becomes a primary driver of the crisis it is responding to. The trigger for such a move can be almost anything: geopolitical conflict, a banking failure, or even a sudden shift in market sentiment. Because the carry trade is so heavily subscribed, the positioning is incredibly crowded. Everyone is on the same side of the boat, shorting the yen. When an event forces a few large players to start covering their shorts by buying back yen, the price moves against everyone else. This triggers margin calls for other leveraged investors, forcing them to buy yen as well, which pushes the price up even further and faster. This is the anatomy of a short squeeze on a global currency scale, and it represents the ultimate nightmare for anyone caught in the yen carry trade. The inherent dangers of the yen carry trade are magnified exponentially by two ubiquitous and honestly pretty poorly understood practices in modern finance: rehypothecation and fractional reserve banking. These mechanisms, act as a powerful leverage multiplier, creating a towering, fragile structure of credit built upon a relatively small base of actual borrowed yen. When a hedge fund borrows yen and invests it in US treasuries, those treasuries don't just sit idle. They're typically pledged as collateral to a prime broker, who can then legally reuse or rehypothecate that same collateral to back its own trades or lend it out to other clients. This process can, surprisingly, be repeated multiple times, creating long chains of ownership and liability all linked back to the original asset. This creates a dangerous illusion of liquidity and safety. So, let's trace the path of our initial 10 trillion yen loan. After being converted to US dollars and used to buy treasuries, those bonds are pledged as collateral. The broker might then lend those treasuries to another fund, which uses them as collateral for its own loan. At the same time, The dollars generated from the initial conversion are deposited in the banking system. Through the magic of fractional reserve lending, a bank that receives a $1 billion deposit can lend out a large portion of it, say 900 million, which is then deposited in another bank, which lends out a portion of that, and so on. The initial borrowed yen is thus multiplied many times over, creating a vast web of synthetic credit and dollar liquidity that is far larger than the original loan. The result is a financial system that is far more leveraged and interconnected than it appears on the surface. Trillions of dollars in global assets are effectively propped up by a foundation of borrowed yen that has been pledged and repledged throughout the system. This creates a massive, hidden systemic risk. While everything is calm, this hyper-leveraged structure hums along smoothly, generating fees and profits for everyone involved. But it is, at the end of the day, a house of cards. The entire edifice rests on the stability of the underlying carry trade. If that trade begins to unwind, the consequences are not confined to the original borrower. They cascade through the entire chain of rehypothecation and fractional reserve credit. The true danger becomes apparent during a crisis. When carry traders are forced to buy back yen to close their positions, they need to reclaim their collateral, the US Treasuries, to sell them for cash. But what if that collateral has been rehypothecated multiple times and is not immediately available? What happens when the massive pyramid of credit built on fractional reserve lending needs to be deleveraged all at once? The system can seize up instantly. The demand to unwind is met with a sudden inability to do so, leading to defaults, broker failures, and a frantic, disorderly scramble for both yen and the underlying collateral. This is how a problem in one specific trade can metastasize into a full-blown global liquidity crisis. When confidence in the yen carry trade finally shatters, the process of unwinding is not orderly or graceful. It's actually a brutal, self-reinforcing stampede for the exits. The trigger could be any of the risks we've already discussed: a Bank of Japan rate hike, a Federal Reserve rate cut, or even just a sudden spike in the yen's value. But, regardless of the cause, the effect is always the same: a massive, simultaneous and desperate demand to buy Japanese yen. This isn't just a few hedge funds closing their books. It's a systemic event involving trillions of dollars in leveraged positions that must be unwound all at once. The market basically becomes a one-way street where everyone is a buyer of yen and a seller of everything else. The scale of the problem is, honestly, difficult to comprehend because of the opaque nature of rehypothecation and over-the-counter derivatives. The notional value of yen-funded trades is estimated to be in the many trillions of dollars, which far exceeds the actual physical supply of yen available for immediate settlement. So, when the unwind begins, traders who borrowed yen must sell their foreign assets, US stocks, bonds, real estate, crypto, just to obtain the dollars needed to then buy yen. This mass liquidation puts immense downward pressure on global asset prices. At the same time, the surge in demand for yen causes its value to skyrocket, amplifying the losses of those who are slowest to act. A particularly telling historical parallel really illustrates this fragility. Consider a major event where Japan, in an effort to stabilize its currency, sold a reported $200 billion of its US Treasury holdings. Logically, selling US assets to buy yen should strengthen the yen. However, in a scenario twisted by hidden leverage, the opposite could actually occur. If the market perceives this sale as the canary in the coal mine, a sign that the primary collateral backing the entire multi-trillion-dollar carry trade edifice is being liquidated, it can trigger panic. Traders might realize that the very foundation of their positions is being sold out from under them. This can paradoxically cause a collapse in confidence and a flight from the yen, as seen in a past event where the currency dropped 22% unexpectedly, simply because the market feared a complete structural failure. This chaotic unwinding hurts everyone involved, but it's especially devastating for those who are highly leveraged. As the yen appreciates, margin calls are issued by brokers. Traders who can't meet these calls are forced into liquidation, meaning their brokers sell their assets at fire sale prices to cover the yen loan. This forced selling adds even more fuel to the fire, pushing asset prices down further and the yen up higher, triggering yet more margin calls in a vicious doom loop. It's a frantic race to the bottom where the supply of available yen is finite and the demand from panicked leverage players becomes virtually infinite. The beast, once awakened, just devours everything in its path. The catastrophic unwinding of the yen carry trade wouldn't be a contained event limited to currency markets. It would really be a tsunami of liquidation that crashes across the entire spectrum of global assets. The institutions engaged in this trade are some of the largest and most interconnected in the world, and their leverage positions are woven into the fabric of the financial system. When they're forced to deleverage, they don't sell what they want to sell. They sell what they can sell. This means the most liquid assets are the first to be thrown overboard in the desperate scramble for cash to buy back yen, which triggers a correlated collapse across seemingly unrelated markets. The stock market would be one of the first and most visible casualties. Trillions of dollars in global equities are held by funds that are in some way financed by the yen carry trade. An unwind would force these funds to liquidate their stock portfolios en masse, leading to a sharp and brutal market tanking. We could see declines that rival the worst days of 2008, as forced selling just begets more panic selling. Similarly, the cryptocurrency market, which is often seen as a high-risk, high-liquidity asset class, would face immense pressure. Sudden, unexplained drops of hundreds of billions of dollars in crypto market capitalization, like those we've seen in recent times, could very well be the tremors of larger carry trade players liquidating positions to meet margin calls. Paradoxically, while most assets would plummet, a great unwind could also trigger explosive rallies in a few niche, heavily manipulated corners of the market. That's because the same large financial institutions engaged in the carry trade are often also carrying massive, hidden short positions in certain assets. A systemic crisis forces these positions into the light. For instance, if banks have suppressed the price of silver for years through enormous paper short positions, a liquidity crisis that forces them to close those shorts could lead to a legendary short squeeze. With a sudden desperate need to buy physical silver to cover their paper liabilities, the price could break through long-suppressed ceilings, like the critical $50 per ounce level, and soar into uncharted territory. A similar dynamic could play out in so-called meme stocks like GameStop. These stocks are notorious for attracting huge short interest from institutional players. A market crisis that exposes hidden swap positions and forces shorts to cover could ignite another spectacular squeeze, completely detached from the company's underlying fundamentals. So, the unwind of the yen carry trade wouldn't be a uniform decline, but a violent repricing of everything. It would punish the long-only investor while potentially creating explosive, once-in-a-generation opportunities in assets that have been the subject of intense and concentrated short selling by the very players whose leveraged world is collapsing around them. As if a full-blown yen carry trade unwind weren't chaotic enough, its collision with escalating geopolitical tensions could create an even more volatile and unpredictable outcome. Imagine a scenario unfolding today, in late 2025, where the global financial system is already teetering on the brink of a deleveraging event. Now introduce a major new policy shock, the imposition of significant new tariffs on goods imported from China, with a particular focus on industrial and precious metals. This action, designed as a tool of economic statecraft, could act as a powerful accelerant in a market already saturated with gasoline. Consider the impact on an asset like silver. In our unwind scenario, large banks are already under immense pressure, forced to buy back physical silver to cover colossal short positions that have just been catastrophically exposed. This alone would send the price of silver skyrocketing. Now, add a hefty tariff on all imported metals. This would instantly raise the cost of acquiring silver from one of the world's largest producers, further constricting supply at the exact moment demand is exploding. The combined force of a historic short squeeze and a trade war could propel the price of silver to previously unimaginable levels, creating a feedback loop of pure financial mayhem. This leads to a fascinating, albeit highly speculative, thought experiment regarding US government finances. If the price of silver and other tariffed metals were to multiply by 10, 20, or even 50 times their original value due to this perfect storm, the revenue generated from the tariffs could become astronomical. In a theoretical world where trillions of dollars worth of metals are being frantically traded at hyperinflated prices, the tariff income collected by the US Treasury could, in a very short period, reach sums that are large enough to make a noticeable dent in the national debt. It's a wild scenario, but it really highlights how the intersection of financial crisis and protectionist trade policy can produce bizarre and unforeseen consequences. Of course, this wouldn't be a stable or sustainable solution to fiscal problems. The economic devastation caused by the underlying market collapse would likely far outweigh any temporary windfall from tariffs. Global supply chains would be in disarray, international relations would be in tatters, and the very fabric of the globalized economy would be torn apart. Nonetheless, it serves as a stark reminder that in a deeply interconnected and fragile system, actions in one domain can have explosive and non-linear effects in another. The combination of a financial unwind, a commercial short squeeze, and a trade war is a recipe for a level of chaos that modern markets have never before witnessed. After exploring the labyrinthine risks of the yen carry trade, from interest rate shifts and currency swings to the terrifying multipliers of rehypothecation and the potential for a global unwind, a critical question remains. Is this just a scary story, a theoretical exercise in financial horror fiction, or is it a plausible description of a crisis that could be unfolding right now? The uncomfortable truth is that while the most extreme scenarios are speculative, the underlying conditions and warning signs are very much present in the global financial system of late 2025. The core elements of the story are not fiction. They're features of our modern market structure. The immense scale of the yen carry trade is an undisputed fact. The interest rate differential between Japan and the US has been stretched to historic wides, encouraging unprecedented levels of borrowing. The use of rehypothecation is standard practice at every major investment bank. The potential for a sudden yen appreciation is a constant threat, with the currency having recently experienced bouts of extreme volatility. We've already witnessed tremors in the system. Sudden, violent liquidations in the crypto markets, inexplicable price movements in commodities, and sharp, correlated sell-offs across global equities. These could be isolated incidents, or they could be the foreshocks of a much larger seismic event as leveraged players test the limits of their liquidity. The plausibility of the narrative is reinforced by the sheer opacity of the system. The true size of the hidden leverage and the interconnectedness of derivative positions are unknown, even to regulators. We only ever see the true scale of these risks after they've already blown up. The collapse of long-term capital management in 1998 and the role of credit default swaps in 2008 both served as brutal lessons in how hidden leverage can bring the entire system to its knees. To dismiss the possibility of a yen carry trade unwind causing a similar or even greater crisis would be to ignore the clear lessons of financial history. The mechanisms are in place, the incentives have been set, and the positioning is dangerously crowded. Ultimately, whether this scenario plays out tomorrow, next year, or not at all depends on the actions of central banks and the unpredictable nature of market psychology, but the structure of the risk is real. It's a sword of Damocles hanging over the global economy, a consequence of years of unnaturally low interest rates and the relentless search for yield. The question is not whether the yen carry trade can blow up, but what the catalyst will be, and whether the world's financial firefighters have the tools to contain the blaze once it starts. As of today, October 13th, 2025, the prudent observer must conclude that while the story sounds like a thriller, it's rooted in a frightening reality we cannot afford to ignore.